Hello, everyone. Sorry that we couldn't be meeting live via WebEx, but something came up and I needed to record this. And so thanks a lot for your patience, and hopefully you all are able to check out this video today instead of our class discussion. So today we're going to concentrate our discussion on bonds. I know that so far we've focused our investment chat on stocks, and while stocks are really important, and it seems like that is the most talked about of the securities out there in the marketplace, bonds are nevertheless pretty important. So we'll talk about that here in a little bit. First, I want to mention that on Friday, we are going to talk about the second assignment. So there's 2 assignments this week, and the second assignment involves a little bit of math. And so don't sweat it if you haven't been able to either get to it or you got stuck trying to figure that out. We'll cover that on Friday, as well as have a discussion on some recommendations that I make for you guys when you look at the type of investing that you want to do outside of your 401k and IRAs, and are thinking about jumping into securities. So we'll talk about that on Friday. And don't forget that on Monday, we will have live via WebEx Alan Wright, who is an investment dude with CLA, Clifton Larson and Alan. And you were able to see Alan in the video that I had recorded from last semester that I posted on Canvas. So you already have a little bit of a snapshot of who Alan is and some of the wisdom that he can provide. He's a great guy and a brilliant investment person. So I think you guys will really enjoy speaking to him live. So that's on Monday. And the focus of our discussion will be on mutual funds. And also we'll talk about ETFs, exchange traded funds. So that's the focus with Alan on Monday. So hope you all can make it. So for today, we're going to talk, as I mentioned, about bonds. But before we do that, I want to share with you how we are doing with the purchase that we made on Monday. So for those of you who were in attendance on Monday, I was able to pull up my brokerage account, which is through TD Ameritrade. And while I don't use it that much, it was still pretty cool for us to be able to take a look at my current positions. And then you guys saw me kind of walk you through how you can purchase stocks. And they make it very easy for a client of theirs to make purchases or to sell shares, to do whatever. So we're going to take a look at that. So let's see if I can share my screen here. All right, so we're up and rolling. This is live, and this is my TD Ameritrade brokerage account. And this is essentially a dashboard that I have, which just lists my account positions. So the type of securities that I have in my portfolio. And as you can see here, these are the 4 stocks, and listed here, stocks, the 4 stocks that I own. Now, prior to Monday, I just had 3. I had Apple, Disney, and CVS. And after class on Monday, I was able to purchase the 2 Home Depot shares. And let's see how my purchase is doing after 1 day of trading. So I bought it. So this cost column is what I actually purchased the stocks for. So 558, so about 279 per share for 2 shares of Home Depot. So that's 558. And at the end of trading today, I was down $13.64. So lost 2%, 2.44%. Do I care? No, not really, because I believe that Home Depot will eventually produce pretty big gains. And they're a solid company, and with the home improvement market doing as well as it has been doing, I think we're in good shape. So I'm not sweating it just after one day, being down a little bit. I'm going to hold on to it probably for at least 6 months, maybe longer. But certainly it does make sense to keep checking your portfolio, see how it's doing. So certainly, if I wanted to dump any of these shares, I could easily do that through this brokerage account. All right, so not doing great right out of the gate with Home Depot, but that's okay. Wanted to show you that this brokerage account, like most online brokerage accounts, you have many options besides just the stocks and ETFs. So stocks and ETFs would be under here. And if I clicked on that, it would give me all kinds of options to select stocks to purchase. And then I could purchase mutual funds, and we'll be talking about that with Alan next week on Monday. And then today we're going to be talking about bonds. So let's take a look at that. So if I wanted to purchase some bonds, I could do that through this section of the website. So let's say I want to buy, and it just gives a quick peek at some bonds that I could get into right away. But if I wanted to go over here to this bond wizard and look at individual bonds or CDs, this would give me a simple step-by-step kind of hand holding of how I could get into purchasing bonds directly through these guys. All right, now for some reason that, is it coming? Is it coming? Let's try that again. Okay, here we go. So this is going to walk me through the type of bonds, try to help me determine the type of bonds that I want to purchase. So I could also do CDs, so certificates of deposit. I could get a whole readout of interest rates that I could receive from various banks and financial institutions around the country. So if I just wanted a safe and secure way to put away some money and try to earn a few dollars, then I could do that through the CDs. But I'm interested right now in bonds, so let's take a look at that. I select that. Then it asks me what type of account am I purchasing this investment for. So am I looking for a tax-deferred account? Let's say I had an IRA set up and I was looking for a place to invest dollars for my IRA, then I could click that, or a 401k. I'm not, so I'm just looking for a regular investment. And then it asks if I want to use the income that I receive from this investment of bonds to be tax exempt. And There are some bonds, in particular municipal bonds, that will provide some tax benefits. So let's say I don't need the tax exempt investments. I'll click that. And then how long do I want to hold this investment for? So let's say I'm interested in 1 to 3 years, but as you can see, I could, if I wanted something quick, down and dirty, less than a year, or long term, 20 plus years, I could select time frames. And then I could put in how much I want to invest. I don't have to. Just click next step. And then kind of drilling down a little bit more, the type of investments that I'm interested in. So let's say I'm interested in AAA bonds. So all bonds are rated, and AAA is the highest quality. So it's the most stable, most secure type of bond that you can get, versus down here, which are C rated. There are even D rated that you don't really want to get into. And you can uncheck this if you're interested in bonds that are not callable. What this means is that all bonds have a start date and an end date. So that's known as the maturity date. And so what this says is that if you are okay with looking at bonds that are callable, it means that the issuer, so the company or the government entity that is issuing the bond, they have the right, if the bonds are callable, they have the right to, prior to maturity, say that they're done and they're going to return to principal, and then your yearly interest or income stream is cut short. So is it riskier to have bonds that are callable? Just depends on the type of investment that you're looking for and what you're looking for the bonds to do. But let's just say that I'm okay with taking a look at bonds that are callable. And so I'll just go to the next step. And then drilling down a little bit more, what specific types of products am I looking at? So I'm not interested in CDs, but yeah, I'll take a look at government treasury bonds, corporate bonds, government bonds, and I'm not even really sure what these are. Treasury strips. Not sure what that is, but let's say I'm interested in these. And then it just kind of gives me the results here. So it gives me the top 5 corporate bonds by yield. So by the interest that it pays out. And so these are top corporate bonds. There's Microsoft, Johnson & Johnson. You guys have heard of those 2 companies. There are these federal agency bonds, United States Treasury bonds. And if I was interested, let's say I was interested in this Microsoft, I could click that on. And then I should get a breakdown of what that is. It's my home internet. Super, super slow and unreliable. Go back. Click that again. See if it does anything this time. Yep, there we go. So Microsoft. So I can buy it, and it just kind of gives the breakdown of the bond. Maturity. So when does it come up? When does it close out? August 8th of 2023. 2%. Coupon is the same as the yield. So that's the interest that it pays. And it pays twice a year, semi-annually, in February and August. And then the quantity, the price, and so gives you a lot of information about that particular bond. So through TD Ameritrade, they make it really easy for anyone, any novice, to jump into securities. Again, whether it's stocks or it's bonds or mutual funds or ETFs, all of these things here you can either learn about or you could purchase. So if you really are interested in learning in more detail about really any of these items, I'd recommend just setting up, take a couple $100 and open up an online brokerage account like TD Ameritrade, and maybe buy a share or two, and just have access to all this wonderful information. There are educational programs that they have that can teach you about all these different securities, whether it's stocks or options, bonds, mutual funds, all of this information. They give you tons of great education about each of those. So anyways, that's the wrap on my account. And let's take a look at bonds. So we're going to talk about the basics of bonds. So what are bonds? Bonds, as we've talked about, it's simply debt. So the people that issue bonds are looking to raise money, and they are looking for a loan. So these are companies. So there are corporate bonds, and then there are government entities. There are municipalities, school districts that are trying to raise money by issuing debt. And so people like you and me, we as individual investors can invest, companies can invest in bonds. So contrasting bonds to stocks, as we've talked about, represent real ownership in companies. So when you own Home Depot shares, you are a part owner of Home Depot, and therefore, if Home Depot does well, then you share in the rewards. If Home Depot does poorly, then you take it on the chin. So for me, in one day, I lost $13. Hey, that's the way it goes. Bonds are different. Bonds are essentially an IOU, and corporations and government agree to pay you back your principal after so many years, and each year they're going to pay you interest. So it's as simple as that. Bonds are also known as fixed income. So when you hear people talk about securities, fixed income, what they're talking about are bonds. So fixed income investments equals bonds. So there are several types of bonds. There are government bonds like U.S. Treasury bonds. Corporate bonds, we just took a look at through my TD Ameritrade account. We looked at some Microsoft corporate bonds. So Microsoft is looking to raise some capital, some money, by issuing debt. There are municipal bonds. As I mentioned, municipalities are trying to raise money for infrastructure, for buildings, so they'll issue municipal bonds. And the benefit to investors in investing in municipal bonds is that oftentimes they are tax exempt from federal tax. So that's a big benefit. There are also mortgage bonds as well that are backed by mortgages. So they're pretty secure. So all bonds have a credit rating. I mentioned this earlier. So when I was looking at my TD Ameritrade account for some bonds, I was able to single out only the bonds that had triple A ratings, which is the highest rating. So they go from triple A to double A to A to B to C to D. As you can imagine, the lower down the food chain you go, the riskier the investment is in those particular bonds. So for the most part, you want to stay away from anything that is lower than any type of A rating that a bond may have. All right, some basic bond characteristics. As I mentioned, bonds are a form of an IOU, and it's just an agreement that the lender has with the borrower to repay the loan with interest. It's as simple as that. So there are some unique features about bonds. One is as I mentioned, there's a definite beginning date and an end date. So the maturity of a bond is the date when the principal or what's called the par amount of the bond is paid to investors. So if you have a 10-year bond, at the end of 10 years, that's the maturity date. The total amount that you put into that principal then is returned back to you. Bonds can be secured or unsecured. And all that means is if a bond is secured, it is backed by some sort of collateral. And so an unsecured bond would be a bond that is riskier because it's not backed by collateral. So liquidity preference. If a company or a government entity goes bust, then who's in line to, with their hands out, to get paid for the investment that they put in, or at least part of the investment, so that they can receive some money back? Well, there's a pecking order when that happens, and so those who are what's known as the senior debt holders are in line first, then the junior debtors, and then the shareholders. So there's a pecking order for who gets preference for the assets that are sold if the business entity or the government entity goes belly up. So you'll hear this term, the coupon. The coupon is just, all that is just the interest that's paid to the bondholders. And as we saw with the Microsoft example, they were paying that interest, that coupon, twice a year. So semi-annually they were paying. So bonds are a nice way for folks to receive steady money each year. So with that, if you invested in Microsoft bonds, you would receive twice a year a coupon. You'd get the interest from the investment that you would make. Obviously, that would be dependent upon how much you put in, but then you would receive, I think that was like 2% is what that coupon was for the Microsoft corporate bond. Tax status. As I mentioned, some of the municipal bonds have some tax benefits in that you don't have to pay federal tax. So there are some folks that take advantage of that. I have some municipal bonds, not a lot, but I have some, and so they're those are nice because again, I don't have to pay federal tax on that. And then callability. So I mentioned this as well before, that bonds are either callable or non-callable, meaning that there's a provision in the bond, in each bond, that may allow for the issuer to pay off the debt early. And in doing so, you get your principal back, but you don't get those continued years of receiving coupon payments because they've closed everything out. All right, so you'll hear this, and I'm not sure why securities seem to want to make things so complicated, because they call similar things, different terms. So the bond yield is simply the return that you receive for your bond. So it's the interest, it's the coupon rate that you are enjoying for loaning that money to that corporation or to that government entity. So here's an example of a coupon rate and what the actual yield is on that particular bond. So if a bond has a face value of $1,000, okay, and they have a coupon payment of $100 per year, then the formula is you take the annual coupon payment, which is $100, right? So you're going to get $100 coupon or the interest each year, and you divide that into the face value. All right, so that is the amount of that particular bond. So $1,000 bond that pays $100 per year. So you divide that and you get 10%. So in this simple example, the coupon rate is 10% because you're receiving 10% interest, okay, or yield on the $1,000 face value. So now that's a very, very simplistic, way to calculate what the yield is in this particular example. But bond yields are usually more complicated because they factor in time value of money, compounding interest, and there are pretty complicated formulas that go in to figure the YTM, which is the yield to maturity, the bond equivalent yield, BEY, and the effective annual yield. I used to joke around when I was at work, when we would come across things that were pretty complicated. We would say, if I had 4 hours and a whiteboard, I'd be able to explain it to you. But I think for our purposes, we don't really need to worry about those calculations. Just understand the basic concept is that a bond yield is really what you're going to be making on the bond investment that you're making. So it just comes right down to, what are you making each year? Whether it's a corporation or the government entity, they're holding on to your principal, your money, and then they're going to pay you something once or twice a year. And whatever that is, you divide that into the face value, and that's your interest rate, right? That's your coupon rate. That's your yield. All right. So how do you buy bonds? Well, you just saw through my TD Ameritrade account that it's really easy. You just set up a brokerage account, and you can just do that directly. There are specific folks out there who are bond brokers who that's all they do. They just focus in on buying bonds on behalf of their clients. They usually require minimums of $5,000. And the challenges with those bond brokers is understanding how the commissions are paid. It could cost you up to 2%, versus with a TD Ameritrade, it's just a flat fee per trade that I make. Whether you buy or sell, there's a flat fee for that. Now, if you're interested in buying government bonds, so treasury bonds or treasury bills or savings bonds, you can do that through your local bank, or you can do it online. You saw some of the treasury bonds that were available through TD Ameritrade, so you can do that through the online account, or you can go directly to the U.S. Treasury website and buy US bonds directly from them. Oops. Wow, pretty sensitive. And then there are bond funds. So instead of buying individual, trying to select individual bonds, like I was walking you guys through, there are bond funds. So they're just groupings of bonds. So instead of dumping all your money into one bond, you may spread that over many different types of bonds so that you're, don't have all your eggs in one basket. Now, when we get into talking about mutual funds, a lot of mutual funds have, as part of the overall portfolio, a portion dedicated to bonds. So let's say that you were interested in a relatively conservative mutual fund, and the mix of all the different securities that are part of that particular conservative mutual fund was made up of 60% stocks and then 40% of fixed income, which, as we talked about, fixed income is the same as bonds. So oftentimes mutual funds will have a nice chunk of the overall mutual fund portfolio dedicated to fixed income. Likewise with exchange traded funds, or ETFs, there are ETFs that have quite a few bonds as part of the overall fund, and so you can buy ETFs that would have a mix of bonds and stocks and other things too. You could have commodities, and so any type of security could be bundled in that ETF, but oftentimes bonds are part of that as well. So very easy to buy bonds. I guess ultimately, so why should you be interested in that? I think it's just a prudent way to diversify your portfolio. So again, you don't want all your eggs in one basket. You don't want everything in stocks. You want to have something that is a little bit more conservative, a little less risky. If you could take advantage of some tax savings by not having to pay federal tax on municipal bonds, that's a good way. That's a good approach. Some of the bond investments, for example, the government bonds, are pretty much guaranteed that you're going to receive the yields that that they're set up to provide. The government's not going to go bust, so it's about as secure as you can get. Now, keep in mind that your yield is going to be pretty low. So overall, are you going to earn as much of a rate of return with bonds versus stocks? No, it's just a proven fact that over time bonds are not going to perform at the level of stocks, but at the same time they're not as risky either. So you've got that to kind of balance out, which is why bonds are typically a big part of mutual funds and ETFs, helping to kind of balance things out. All right, come back to me. All right, so that's all I had for today's discussion. Certainly let me know if you have any questions. Either shoot me an email, or we could talk about it on Friday. So looking forward to seeing you guys via WebEx on Friday. Have a great day, and we'll talk to you then.